In 2026, Australia won't have one property market. It will have two. In one group of cities, prices are still accelerating. In the other, buyers are quietly being left behind. If you own property in the wrong city right now, the next 12 months won't just slow your wealth. It will permanently change your financial trajectory.
Australia's property markets,
Australia's housing market,
Australia,
and residential property prices are expected to rise by at least 5% this coming year. New data has shown.
Today, I'll show you exactly which cities surge, which ones stall, and the precise moment in 2026 when the entire market flips. Forget everything you've heard about the Australian property market, because in 2026, there is no single market. There are two completely different realities happening right now, and the gap between them is about to become a chasm. I'm going to show you exactly which cities are set to explode, which ones will stagnate, and the one critical turning point in mid-2026 that changes everything. Right now, Australia's property market is split into two parallel universes. And before you think this doesn't affect you, it does. Because whichever universe your city is in will decide whether your next 5 years build wealth or just tread water. And the numbers are absolutely insane. In Universe 1, we have Perth, Brisbane, Adelaide, and Darwin. Properties are selling in 7 to 8 days in Perth. The median house price in Brisbane just smashed through $1 million in November, up nearly 13% in a single year. Perth posted a staggering 13% growth in 2025, and Darwin, an eye-watering 18%. But in Universe 2, Sydney and Melbourne, something completely different is happening. Sydney's growth slowed to just 0.5% per month. Melbourne managed only 0.3%. The powerhouse cities that used to lead Australia are now trailing behind. This isn't temporary. There's a psychological trigger at play here that's driving billions of dollars in capital from one side of Australia to the other. It's called the affordability migration effect, and it's creating a feedback loop that's become unstoppable. Sydney's median house price is now forecast to hit $1.92 million by the end of 2026. Melbourne will reach $1.17 million. Mortgage repayments in Adelaide now absorb over 51% of household income. That's up from just 27% in 2019. And Perth, Brisbane, and Adelaide have experienced what experts are calling aggressive price growth over multiple years. That's pushed borrowing capacity to its absolute limits. The ratio between property prices and income in Australia is at its most extreme point in 100 years. Not 10 years, not 50 years. 2026 isn't going to be a single story. According to Domain's research, the year will split into two distinct phases, and if you don't understand this timeline, you could make a catastrophic mistake with your money. Phase 1 runs from January to June. The first half of 2026 is going to be driven by what economists call pent-up demand flowing through. Here's what that actually means. Interest rates were cut twice in 2025, in February and May. Those cuts are still working their way through the system like a delayed fuse. Property doesn't react instantly. There's a lag effect. And in early 2026, that lag effect hits full force. But there's something even bigger. The Australian government just expanded the First Home Guarantee Scheme. This is the single most influential demand driver heading into 2026. Previously, first home buyers could only access properties in outer suburbs with a 5% deposit. Now, they can buy properties up to $1.5 million in New South Wales with taxpayer-backed guarantees. Do you understand what that means? Median-priced properties in Sydney are now accessible to first-time buyers with tiny deposits. This is an instant injection of tens of thousands of new buyers into a market that already has listings 18% below the 5-year average. The result? SQM Research predicts that Perth could see growth of 12 to 16%, Brisbane 10 to 15%, Adelaide 10 to 14%, and Darwin, an absolutely wild, 12 to 16% in 2026. Even under conservative scenarios, national dwelling prices are expected to rise 6 to 10%. As prices surge in Phase 1, FOMO, fear of missing out, kicks into overdrive. Buyers who've been sitting on the sidelines watching Perth double in value over 5 years suddenly panic. Auction clearance rates in Sydney and Melbourne, which peaked in August, start climbing again as confidence returns. This creates a self-reinforcing cycle. More buyers enter, supply stays constrained, prices accelerate, more buyers panic and jump in. The cycle intensifies because what works in the first half of 2026 stops working overnight. By mid-2026, affordability doesn't just slow the market, it becomes what Domain calls a handbrake. It doesn't hit every city equally. Sydney and Melbourne, which have been underperforming, they actually might stabilise or even see slight improvements as buyers rotate back to affordable options. Their home price to income ratios, while terrible, aren't getting worse. But Perth, Brisbane and Adelaide, cities that have experienced multiple years of 10 to 15% annual growth, that's where the handbrake slams hardest. Think about it. If you're a buyer in Perth and prices have jumped 90% in 5 years, your borrowing capacity is maxed out. The same property that felt affordable in 2022 is now completely out of reach, and there's nowhere cheaper to go in the city. This is when the two-speed market flips on its head. The cities that were roaring ahead suddenly can't sustain momentum. Meanwhile, previously expensive Sydney and Melbourne start looking like relative value plays, at least compared to their own price history. The Australian Prudential Regulation Authority, APRA, just dropped a bombshell. Starting February 1st, 2026, banks can't lend to borrowers with a debt-to-income ratio above 6 times their income for more than 20% of their lending book. This is called a macro-prudential control. Who does this hit hardest? Investors, people with multiple properties, first home buyers stretching to their limits to use the 5% deposit scheme. And here's the kicker. If this doesn't cool the market enough, APRA has already signaled they'll do more. They could implement a hard cap on investor credit growth, similar to what they did in 2014. That would be a market-killing move for overheated cities. Now ask yourself, does your city still have room to run, or is it already hitting the ceiling? Dr. Shane Oliver from AMP Capital explains it perfectly. With FOMO running hot in Brisbane, Perth and Adelaide, they'll remain the strongest over the next 6 months. But as their affordability continues to deteriorate, some rotation back to Melbourne and possibly Sydney is likely later in the year. This is the rotation effect. Capital doesn't disappear, it just moves. And in the second half of 2026, that capital starts flowing back to the cities everyone wrote off. Now, here's something most people aren't connecting. This two-speed property market is creating a two-speed rental crisis. Unit rents in most cities are rising faster than house rents. Why? Because affordability pressures are pushing tenants down market into smaller, cheaper dwellings. In Brisbane, Adelaide and Perth, this trend is accelerating. Vacancy rates in Brisbane are below 1% in many suburbs. Perth has some of the lowest vacancy rates in the nation. Rental supply is being strangled by the same forces crushing buyer affordability. According to CBRE, median apartment rents could grow 24% between 2025 and 2030 across capital cities. By 2030, 92% of two-bedroom apartments will rent for over $700 per week. 1/3 will exceed $1,000 per week. For investors, this creates a perverse opportunity. Yields in boom cities remain strong, 4.5% to 5.2% in Brisbane, even as prices soar. But it also means renters are trapped in a cost of living crisis with no escape valve. While the median market struggles with affordability, Australia's prestige market is operating in a completely different dimension. Sydney accounted for 17 of the top 20 residential sales in 2025, totaling $1.1 billion. Suburbs like Point Piper, Bellevue Hill and Vaucluse are pushing into the tens of millions. These ultra-high net worth buyers aren't sensitive to interest rates or borrowing capacity. They're buying with cash or massive equity. Meanwhile, a first home buyer in Western Sydney is fighting over a townhouse with 20 other bidders, stretching their borrowing capacity to breaking point just to get a foothold. This is the ultimate two-speed market, not just city versus city, but class versus class within the same city. If you're asking, where should I buy in 2026? Here's the strategic breakdown. First half of 2026, Perth, Brisbane, Adelaide, and Darwin continue their explosive runs. These cities benefit from tight supply, strong population growth, and momentum. You're buying at or near peak affordability pressure. The margin for error is thin. Second half of 2026, Melbourne becomes the sleeper pick. Its relative underperformance has created a 13% valuation discount compared to Sydney on a historical basis. ANZ Bank and KPMG both forecast Melbourne could post some of the strongest growth in 2026 to 2027 as affordability-driven demand returns. Domain expects Melbourne to hit $1.17 million, recovering fully from its recent weakness. Sydney is trickier. At $1.92 million median, it's becoming prohibitively expensive even for wealthy buyers. Growth will likely moderate to 3 to 7%, but quality suburbs with strong fundamentals will still perform. Darwin, with 18% growth predicted for 2026 under some scenarios, it's driven by infrastructure spending, defense projects, and investor sentiment. But it's a small market. Moves can be dramatic in both directions. Remember those two phases I mentioned? Here's exactly when you need to act. January to March, 2026. First home guarantee expansion kicks in. Auction clearance rates surge. This is peak FOMO territory. If you're a buyer, this is the most competitive window. Expect multiple bidders, fast sales, and price escalation. April to June 2026. Momentum peaks, but affordability strain becomes visible. Borrowing capacity limits start binding. If you haven't bought by June, wait. July to September 2026. The rotation begins. Markets cool. Melbourne and Sydney start showing relative strength. This is when smart money repositions. October to December 2026. The market finds a new equilibrium. 2027 outlook becomes clearer based on whether APRA tightens further and RBA holds rates or hikes. February 1st, 2026. That's when APRA's debt-to-income cap takes effect. If you're looking to buy as an investor or with high leverage, get your loan approved before February 1st. After that date, banks will be far more cautious. Some borrowers who could get approved in January won't qualify in February. If you bought a median house in Perth in 2020 for around $500,000, it's now worth approximately $950,000. That's nearly $500,000 in equity gain, passive, tax-free if it's your primary residence, and compounding. If you bought in Melbourne in 2020 at $775,000, you're sitting at maybe $775,000 to $800,000 today. Minimal gain. Years of dead money. If Perth maintains even 6% annual growth through 2027, that 2020 buyer will have over $1.1 million in property value, doubling their money in 7 years. The Melbourne buyer, still stuck around $850,000, maybe $900,000 if they're lucky. This is how wealth gaps explode. Same time period, same effort, different city, $500,000 difference in outcome. And if you're a renter watching this happen, you're not building equity at all. You're falling further behind every single year as rents consume more of your income and home ownership drifts further out of reach. Australia's two-speed property market isn't a bug. It's a feature. Policymakers want capital to flow to Perth, Brisbane, and Adelaide. It takes pressure off Sydney and Melbourne. It distributes population growth. It supports state economies. But the human cost is staggering. Families are being forced to choose between financial opportunity and proximity to family, jobs, and community. Young Australians are being told, move to Perth if you want to own a home, when their entire life is in Sydney. The property market has become a sorting mechanism, not just economically, but geographically and socially. If you're an investor, this two-speed market presents a unique challenge. Do you chase momentum in Perth and Brisbane, accepting that you're buying near the top of a cycle with limited upside but strong rental yields? Or do you bet on mean reversion in Melbourne and Sydney, buying into underperformance with the hope of a 2027 to 2028 recovery? There's no objectively right answer. It depends on your time horizon, risk tolerance, and belief in long-term structural drivers. But here's what the data says. Over every 20-year period since World War II, Australian house values have tripled. That requires an average annual growth rate of 6%. In 2025, 5 of 8 capital cities hit that mark. The key is not market timing, it's time in the market. And buying quality assets in supply-constrained locations with strong long-term fundamentals. Before we wrap, let me give you 3 red flags to watch in 2026 that would signal this forecast is breaking down. Red flag number 1, RBA raises rates instead of holding or cutting. If inflation stays sticky and rates go up, all bets are off. Property would likely correct across the board. Red flag number 2, APRA implements aggressive new controls beyond the debt-to-income cap. A hard investor credit cap would freeze markets immediately. Red flag number 3, major economic shock, global recession, China slowdown, commodity price crash. Perth and Brisbane are particularly vulnerable to external shocks given their economic reliance on resources and trade. If you see any of these, pause. Don't panic, but reassess. Markets can turn faster than forecasts adjust. So here's the bottom line. Australia's two-speed property market isn't slowing down in 2026. It's accelerating in the first half, then fragmenting even further in the second half. The cities that were left behind, Melbourne and Sydney, might finally catch a break as affordability rotates the capital back their direction. But the boom cities, Perth, Brisbane, Adelaide, will hit an affordability wall that even strong fundamentals can't overcome. If you're a buyer, your window of opportunity is narrow and specific. First quarter 2026 for boom cities. Second half for recovery plays. If you're an investor, focus on quality over momentum. B and C grade properties will get hammered when the market moderates. A grade assets in supply-constrained locations will outperform dramatically. And if you're just trying to get into the market as a first home buyer, the truth is harsh. It's harder than it's ever been. The first home guarantee helps, but it also adds fuel to an already overheated fire. One thing is certain. The gap between the haves and have-nots in Australian property is about to explode wider in 2026. Which side of that gap you end up on depends on the decisions you make in the next 6 months. Remember the wealth gap I mentioned at the start? This is exactly how it forms, quietly, unevenly, and then all at once. That's it for today. If this opened your eyes to what's really happening, hit the like button. If you want more data-driven property analysis, subscribe. And if you've got thoughts on where you think the market is heading, drop them in the comments. I read every single one. See you in the next one.